So in this video, I am going to provide an overview to the material I had sent and really an answer to the question of, is there a way to improve the long-term annual internal rate of return of a policy? So your specific question was, I'm going to pull it up actually. Thank you so much for the Word document and screenshots. I'm going to go through those as well. But your specific question was this. Let's start with the initial question, just when we had the initial interaction. Which as you examined your policy or the two illustrations, you noticed really between the ages of 88 and 97, the internal rate of return really starts to go down, looking at it on an annual basis. And is there anything that can be done to prevent it? Meaning, can we improve the cash value even further? Fun stuff, right? You can tell I'm a nerd and you can totally make fun of me for that. So the answer is unfortunately not. What you will find with a whole life insurance product is as time passes, as we grow older and we examine the actual internal rate of return, net growth rate, and cash value, gradually declines from year to year. You're still positive. So for example, I might earn 5% the year I'm in now, and then next year I earn 4.97. But if the dividend rate's consistent, I still see it gradually declining. And usually this will occur somewhere between 25 and 30 years into a policy, unless I'm starting a bit younger. I'm going to pull up a couple examples with the illustrations we're looking at for you and also a younger individual as well. But you had sent back these two guys. Thank you for the screenshots as well. Visuals help me tremendously because I'm slow with this stuff sometimes, no matter how long I do it. So you had noticed that some other agents are illustrating policies that don't seem to do that, particularly with examples that have higher base premiums. So the screenshots you sent, you've got policy one, which was a 1090 split displayed from another agent. And what we've got here, it looks like heavy funding, really through year 21, that's when they're making payments, and then the funding drops according to their chart. And what we've got here in green is the cash value growth. And then we see a decline here, comes up for a little bit, then goes down, then comes back up and kind of follows a wacky pattern. Which, looking at that, what it could look consistent with, and let me know if this is what you're thinking as well, is on the annual internal rate of return. This looks like it's consistent with the fact, or consistent with your policies and illustrations where we saw that IRR gradually decline. But then here gets a little wacky there where it goes up then comes down, which could be a result from the reduced paid up, but it doesn't look like that was not done in this example. Regardless, what you had mentioned here is the other policies here seem to indicate differently, where one was shown where the cash value steadily increases here. So this was the example where in orange here, you've got the premiums. And then you've got the cash value, which starts lower than the other example. Goes up, goes up, goes up, then comes down here, then begins to climb up again. So what I will mention here, when we see this column or this verbiage here, annual cash value growth, what it looks like was done here, or what was done here, is the cash value growth is including the premium payments that are made to the policy. And it's including both the premium and PUA payment. So for example, if we paid in 40 grand right here, and this cash value was $35,000, just for the sake of simplicity, what this is showing is in the first year, the cash value grew by $35,000. I paid in 40 and I have 35 in cash value, and that's referred to as the annual cash value growth column. And why we see a dip here is because when we stop making payments, what you'll notice, the amount the cash value did not grow by is the amount we did not pay. So let me demonstrate that just with your policy here, because I know that can be a little confusing, or if we flip positions, I'd be a little confused there. So here we've got the two examples of your policies up, the Mass Mutual 15 pay and then the Guardian product as well. So as far as the annual cash value growth, so often what we'll see here is I'll refer to it as the gross CV growth, and then we'll include another column and we'll call net cash value growth. And I do prefer the net, and you'll see why in a second. Let's go purple with net, and we'll leave gross in, let's go a different color. How about orange? No, that's too light. Let's go this dark orange brown color. All right, so what we've got here, first year, it would just be $44,000 in change, meaning you paid in 50 grand, and the annual cash value growth column on that chart, so going back to it, represents, here's my cash value growth, $44,000 in change. Where in reality, that is not the case, just with how the charts are actually drawn up here. We took a $5,000 hit that year, almost a $6,000 hit, because I paid in 50 and I only have 44 in cash value. Now, as each year passes on the gross column here, and you'll see how this matches up with the spreadsheet, or the chart, I should say, that you'd sent. Notice while you're paying here, by year 3, paying 50, the annual growth exceeds your premium payment of 50 grand. Going back to this guy, this chart, what you'll notice here, there's the payments. By the third year, that cash value is equal there in that particular example, or just beginning to exceed the actual payment. It will be very similar to this. Then the next year, we see that the annual cash value growth exceeds it and gets better and better each year. Then what happens as we go down, there's my cash value growth. Because I'm no longer paying in, that's where this chart experiences a big decline in cash value growth. Was 88, now goes down to $47,000. Now, why it went up and went down here, not sure what was going on in that particular example. I could study it a bit more, but maybe term rider wasn't dropped or something like that. Doesn't really matter. Point is, we will see the cash value continue to grow here no matter what. And really what I would look at, and this is just how I like to do it, is I do like to back out the payments that I'm actually making, because that's money I've paid in. There we go. So here's my net. And what you'll see in this trend, just a constant increase. So if we look at this guy, year 15 grew by $47,000 in change. The next year, we're on that line graph, it would take a dip. In reality, the net growth does not take a dip. To hit on your main question here with the annual internal rate of return. So after the funding, there's your IRR. And as time passes, you mentioned really around age 88, you notice it starts to really take a dip here. So the annualized internal rate of return is declining. However, when we look at the net cash value growth, that continues to increase. Just it's growing by a little bit less and less each year from a percentage standpoint, because we're getting closer to death. The insurance company knows they're going to pay out a claim sooner, so the expenses are beginning to increase there. For the whole life insurance product, what you'll always see happen, or how it works, is you've got insurance expenses that gradually increase internally. However, they never exceed the guaranteed rate in the product. So no matter what happens, your value will continue to increase. Just what happens is as we get older, it's going to slow down a little bit because we're getting closer to the end, if that makes sense. So if we look at this guy here, let's do the same thing. We've got the gross cash value growth and then the net cash value growth. But even when that IRR begins to slow down in this particular example, you won't see any decline in the cash value growth there. It continues to go up, which is exactly what it should do. The only reason it would go down, so for example, if let's say year 20, it grows by $25,000, and then the next year it grew by $24,000, so it grew by less than the following year. The only reason that would happen is A, if I have a term rider on the policy that I didn't reduce, I didn't cut it off, and we just completely neglected the situation. B, if there's an outstanding loan on the policy and the loan interest is exceeding the interest earned on the policy, meaning the cost, the actual loan interest expenses, perhaps I have a premium due that I'm not paying, all of the expenses with the policy are exceeding the interest earned. That's where I could see it go backwards as well. But if we do everything properly, we'll always see an increase. That'll be both on the guaranteed and non-guaranteed values. So it's fairly simple to do as long as we set it up right. Let's look at a younger individual, 30 years old. And what I ran here is just a 1090 split. This is a Mass Mutual high yearly cash value product. That's how the cash values are richer upfront. We've got the annual internal rate of return, also the average internal rate of return, a 1090 split where he funded for 20 years, and then also a 1090 split, which is the exact same policy, but where he funded for 50 years. You'll notice by year 20, everything is identical here. And this is actually from one of our YouTube videos entitled, How Long Can I Fund a 1090 Split? And we go through the detailed illustrations and everything there too. But I can always send them to you, no problem, if you'd like to pick them apart. So here we go. Funding through year 50. And here's something pretty cool, or pretty interesting, I should say, that you'll notice. So if this individual decided to stop at year 20 and the dividend rate stayed the same forever, which it won't, but let's assume it did. What these borders represent is that we went reduced paid up here. When we go RPU, we see this nice jump on the internal rate of return. And again, the column to the left is the annual internal rate of return. But you'll notice some consistencies with your policy. Goes up and then begins to come down. Now, both your example and this example are examples where we stopped the funding after 20 years. Yours was 15 years and the Guardian illustration was only 3 years. I know you might continue to pay the premium thereafter. I've got the option to do so, but these are shorter funding scenarios. Well, 20 years is short to some, long to some people. All depends on the individual. Progressing to the example to the right. So here we'll see, watch this. When you continue to make the same payment, IRR does not take a steep increase, follows really the same pattern it did before, where it gradually increases until about age 60. What do you notice there? Goes up, goes up, goes up, then begins to come down. And then when you hit that kill switch, the reduced paid up option, you'll notice a similar trend there, where we see a nice little jump on the internal rate of return. Now here we did it very close to our expiration date, meaning based on the insurance company's mortality tables, they think we're going to die soon. So we do take a jump, but it's not as significant as it was for the individual or when the guy did it at age 50 in this example. So we take a jump, but then it begins to decline again. There we go. However, if that annual IRR is positive, which it is here, it's never in the red with the exception of the early years. If it's positive, you'll always see the cash value increase. That line on the graph that you had sent us a screenshot of. The only thing I would do differently here, just to make it a bit more transparent, and this is just my opinion, I'd never tell another agent how to run his or her business. The only thing I would do differently is show the cash value growth without premium payments made. This way you can see just what's the net cash value, the total amount growing by net of my payments. Maybe I can look at a total cash value column as well, so I can see how much I can access, but just what's the annual cash value growth that I'm receiving from the insurance company. And what would look different here, if we're going to turn this Excel sheet into a chart, if we're negative in the first 2 years, and I actually see years 1 and 2, I'm in the red, and I get above that line and it would do nothing but gradually increase over time. So because they've got the payments in there, that's where we get a little bit of fluctuation with the annual cash value growth, which, hey, I mean, however people are going to run their business, that's ultimately up to them. Let's do the same thing here. we go. So even though that annual IRR declines, we'll never see a dip like the charts you had sent had indicated. So point to all of this is you will see it constantly increase, but the annualized IRR, really no matter what we do, no matter what product we use, you will see that gradually decline over time. No, that's a mouthful, a lot of information that I just gave you there. Hopefully the visuals help. If there's anything that is confusing, I can certainly put additional spreadsheets, recordings together. We can talk through it over a Zoom call or a phone call. Let me know what is easiest for you. I'd be happy to connect anytime you'd like at your convenience. And that is all I have for today. Have a great day and talk to you soon. Enjoy. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.